Chloe did everything right. She saved $100,000. She researched suburbs for 8 months. She ran the numbers on rental yields, mortgage repayments, vacancy rates, and capital growth corridors. She spoke to a mortgage broker. She was pre-approved. She found the property. She made the offer. And then the bank said no. Not because her finances were bad, not because her savings were insufficient, not because she chose the wrong property or offered too much or misunderstood the process. The bank said no because 12 months earlier, Chloe had taken parental leave. And in the eyes of the lending system, a woman who paused her career to have a child is a financial risk. Her friend Priya bought the same week Chloe was rejected. Same city, same price point, same deposit. Priya had never taken parental leave. Her income was continuous. Her loan was approved in 4 days. Same decision, same money, same research. 2 completely different outcomes. And the gap between those 2 outcomes, measured in dollars over 20 years, is what this video is about. Let's establish exactly who Priya and Chloe are, because this story only works if you see yourself in at least one of them. Both women are 32, both earn $85,000 a year, both have been diligently saving since their mid-20s and have arrived at this moment with $100,000 in the bank. Both did the same reading, listened to the same podcasts, had the same conversations with the same mortgage broker. The only difference is this: Priya has worked continuously since graduating. 12 years of clean, unbroken income sitting in her tax returns like a perfect ledger. Chloe took 12 months of parental leave 14 months ago. She has been back at work for 2 months when she applies for her loan. She is earning her full salary again. She has $100,000 saved. She is, by every measure she understands, financially ready. The bank does not agree. Here is what most people don't know about how Australian lenders assess borrowing capacity. It is not just about what you earn right now. It is about what you earned over the past 12 to 24 months. Lenders average your income across that window to calculate your serviceability. If 12 of those months were spent on parental leave payments, which in Australia average around $1,400 a fortnight through the government scheme, well below a full-time salary, your averaged income is significantly lower than your current income. Chloe's averaged income over the past 14 months calculates to approximately $61,000. Not $85,000, $61,000. That single calculation reduces her borrowing capacity by roughly $90,000 to $120,000, depending on the lender. The property she wanted cost $600,000. With a 20% deposit, she needed to borrow $480,000. Her broker tells her the maximum she can borrow right now is $390,000. She is $90,000 short. Not because she doesn't earn enough, because of when she took leave. Priya borrows $480,000 without friction. She buys in March 2024. Tenant in by June. Chloe goes home and waits. Now, I want you to stop and sit with something for a moment. Chloe did not make a mistake. She did not miscalculate. She did not misunderstand the process. She made the same decision as Priya with the same money. At the same time, for the same reasons. The system returned a different answer. That is not a personal finance failure. That is a structural design problem. The Australian lending framework was built around a model of continuous, uninterrupted, full-time employment. A model designed in an era when the default borrower was male, and the default assumption was that income would not pause for caregiving. It has been incrementally updated. It has not been fundamentally redesigned. What that means in practice is this: the moment in a woman's life when she is most likely to be thinking seriously about long-term wealth building. Her early 30s, post-children, re-established in her career, motivated and ready, is precisely the moment the lending system is most likely to penalize her. The timing couldn't be worse, and almost nobody is talking about it. Chloe waits 19 months. She keeps saving. Her income history cleans up. She applies again. This time she is approved. She buys in October 2025. Priya bought in March 2024, 19 months apart. Now let's put a number on what 19 months costs. The property Chloe wanted was listed at $600,000 in March 2024. At 6% annual growth, 19 months of appreciation adds roughly $58,000 to the purchase price. Chloe buys a comparable property for $648,000. She needs more deposit to maintain her 20% position, or she pays lender's mortgage insurance, roughly $8,000 to $12,000 on her loan size. That number is $58,000 in additional purchase price, plus up to $12,000 in lender's mortgage insurance. Chloe's parental leave cost her between $58,000 and $70,000 in entry price alone, before she has paid a single dollar of mortgage, before she has earned a single dollar of rent, before the investment has had a single day to grow. $70,000 for taking leave to have a child. Here is where compounding turns a bad situation into a very expensive one. Compounding does not add, it multiplies. Every month of growth creates a larger base for the next month's growth. Starting 19 months later does not mean Chloe is 19 months behind in a straight line. It means she is permanently behind on a curve that accelerates over time. By year 20, Priya's property, purchased at $600,000 in early 2024, is worth approximately $1.93 million. Chloe's property, purchased 19 months later at a higher entry price, is worth approximately $1.83 million. That is $100,000 in asset value alone. Add the cumulative difference in rental income collected, the interest paid on Chloe's larger loan balance, and the lender's mortgage insurance she paid at entry. And the total wealth gap between two women who made the identical investment decision is somewhere between $130,000 and $160,000. $160,000. Not because one of them was smarter, not because one of them worked harder, not because one of them chose a better investment, because one of them had a baby. Here is what this video is and what it is not. This is not a case against property investing. It is not a case for index funds. It is not telling you what to do with your money. What this video is telling you is something more specific and more useful than a verdict. The lending system has a structural bias that most women walk into without knowing it exists, and the cost of not knowing, measured in the real dollars of Chloe's story, is not trivial. It is not a rounding error. It is potentially six figures over the life of an investment. The question is not whether to invest in property. The question is when. And the answer to that question, for women specifically, is not just about whether you have a deposit. It is about where you are in your income continuity window, and whether the bank's version of your income matches your actual income. Those are two different numbers, and most women have never been told they exist simultaneously. So, what does Chloe do differently in the version of this story where she wins? She plans the timing. Not perfectly. Life does not allow for perfect timing, but she understands, before she goes on parental leave, that she is entering a window where her borrowing capacity will be temporarily and significantly reduced. She knows that window lasts approximately 12 to 24 months after her return to full-time work, depending on the lender. She uses that window deliberately. She keeps saving. She builds her deposit larger so that when she does buy, she has more than 20%, and lender's mortgage insurance is off the table entirely. She enters the lending conversation knowing her averaged income figure before the broker calculates it. So she is negotiating from information, not discovering things in real time. She does not panic buy before she is ready. She does not wait indefinitely and let fear make the decision for her. She buys at month 22, post-return instead of month 2. And that 20-month difference in her income averaging calculation changes her borrowing capacity by $80,000. Same woman, same income, 20 months apart, $80,000 difference in what the bank will lend her. That is not a small variable. That is the variable, and it is entirely within her control once she knows it exists. Before you close this video, here are the 3 numbers every woman needs to know before she walks into any property finance conversation. The first number is your averaged income, not your current salary. Your averaged income over the past 24 months, including any parental leave, part-time, or career break periods. Calculate it yourself before your broker does. Know what the bank will see before you sit down. The second number is your serviceability buffer. Australian lenders assess your ability to repay not at the loan's actual interest rate, but at a buffer of approximately 3% above it. Know what repayment figure the bank is stress testing against. Because that number, not the actual repayment, is what determines your borrowing limit. The third number is your optimal entry window. Based on your income history and any planned or recent career interruptions, calculate the month at which your average income most closely reflects your actual income. That is your strongest borrowing position. Plan around it. These are not financial advice. They are financial literacy. There is a difference. Financial advice tells you what to do. Financial literacy tells you what is happening. So you can decide for yourself. Chloe's story is not a cautionary tale about parental leave. It is a cautionary tale about walking into a system without understanding how it scores you. The system is not going to explain itself. Nobody is going to sit across a desk and say, by the way, your income averaging is working against you right now, and here is when it will stop. That information exists. It is not secret. It is just not volunteered. The borrowing capacity trap only catches you once. After that, you know where it is. And knowing where it is changes everything.